Hello, everybody. A warm welcome on this beautiful day to our Crew New York speakers and members, you. I am Barbara Champeau, a director and committee chair of Crew New York. A few housekeeping items before we begin. This event is being recorded, I think. We intend to post it on Crew New York's YouTube channel and the link distributed to all registrants in the next week or so. Please turn your video on if you're comfortable doing so. Seeing faces rather than names is certainly more welcoming. If you have not already done so, and I can't see you all, so I can't tell, please rename yourself with your first and last name and company name so that we know who you are. This is going to be especially important in the workshop portion. Finally, please note the opinions expressed by our panelists are their own, and they do not necessarily reflect the views of their respective companies. Before getting down to business, I must quickly recognize and thank Crew New York's sponsors for their longstanding loyalty and generous support of Crew New York. They enable us to serve you, our members. There are too many to single out, all of them right now, but I will have Realty and TREP. I believe we have some representatives of those companies on, so thank you so much. If we have the time at the end, I will highlight you. Crew New York also extends its appreciation to its first ever diversity champions and these past Crew New York presidents who generously donated to our past President's Scholarship Fund for 2022. On behalf of Crew New York, thank you for joining us for an assuredly content-rich discussion among our speakers on the development life cycle, focusing today on finance and investment. Which is really the same thing, but I'll get to that later. Today's panel of amazing members, all leaders in their respective life cycle roles, will certainly yield insightful observations, pragmatic guidance, and thoughtful synergies and opportunities. But first, briefly, a bit about today's program. A collaboration between our legacy leaders and member engagement and empowerment committees. Today's program is the second session of a series on the development life cycle, which we expect will continue in 2023. So please stay tuned for dates later this fall. Many of Crew New York members, as I hope you all know by now, play some role in the development life cycle, but we have discovered some of them may not fully understand where they fit in the bigger development picture, where there are potential synergies with other development professionals and how they intersect on a development project, and certainly what are emerging opportunities that they could tap into together. So we hope to bridge some gaps by affording the benefits of the collective wisdom and experience of our panel today. In reviewing the registration list, as I mentioned in the email I sent last night, we noticed that while you represent a broad range of commercial real estate roles and sectors, most, if not all of you, are in some way, and by you, I mean those here today, are in some way directly or indirectly involved in development. Very few of you, however, are professionals in the finance space, debt or equity. Accordingly, we prepared and distributed last night a glossary briefly describing some of the relevant and basic terms and concepts, and we hope you find it helpful. Let's first take a look at, our development life cycle model. As you can see, financing is involved in just about every phase, so the likelihood of the project financing affecting your role in the project are high, and some of you may directly interface with some of those funding sources. For instance, depending on the master agreement used for the project development, a construction manager may be required to certify that certain phases have been completed as required and its subs fully paid. The failure to provide that certification means the funding for that phase will not be advanced, and I suspect very soon work will be stopped, and that means some of you will stop working. Architects also may certify for lenders completion of a project in accordance with plans and specs and provide other services to a lender on a big development project. And of course, as we all know, I think, many other professionals are involved in project diligence and advice, not only to the developers on the development side, but as to the lenders and the investors as conditioned to their advancing funds. They include environmental engineers, surveyors, title companies, appraisers, architects, accountants, and attorneys, among others. The capital markets and commercial real estate are inexorably intertwined, particularly in development. And both are impacted by the economy and market conditions because they go to and affect the risks inherent in any financial transaction, particularly real estate development transactions. By the way, the capital markets refers to the exchange system that transfers capital from investors who want to employ their excess capital to businesses requiring it to finance various projects. Unlike many other transactions, however, due to the risks and complexities involved, a new development or redevelopment project is generally funded through a combination of sources, providing access to their capital under various terms and interest rates, which will vary depending on several things, including which project phase or phases their capital will fund, how much capital they are willing and able to provide, what rate of return on their investment for this capital they require, and what is their risk tolerance for the particular project and ability to take collateral to secure repayment. Keep in mind, as those of you involved in the construction and project management sides will understand, there are tremendous risks involved in developing a commercial real estate project. Among them, zoning, land use, and environmental issues may delay commencement of construction in New York City, often for years, depending on where it is, and have sometimes suspended construction once begun. Supply chain issues and shortages may delay reaching construction milestones, which impact and cascade, having a number of impacts on subcontractors and the like. And it'll impact pricing and the ability to pay and be paid on time. So developers will typically secure several types of capital or funding for their projects, all at different rates and terms, as I mentioned, effectively in layers, often referred to as the capital stack, to spread the risk among the layers. The capital stack refers to the layers of capital that go into purchasing, developing, and operating a commercial real estate development projects. It outlines who will receive the income and profits generated by the property and in what order. The capital stack also defines who has the first right to foreclose on the property or take it back because it's collateral for their loan, or an interest in the property owner as collateral in the event the property owner defaults on repayment. The capital stack is typically comprised of 4 sections in the following order. Equity or common equity, as you see at the top of the Empire State Building. Common first, preferred second, and debt, mezzanine and senior. They're going in inverse order of priority and payment priority. Although common equity, as I just said, is listed first in the stack, it holds the lowest priority, meaning common equity lenders are paid last. Senior debt at the bottom of the stack holds the strongest priority, meaning senior debt lenders are the first to be paid. While investment level, each investment level comes with its own risk and reward, the higher positions in the capital stack typically earn higher returns as a result of their higher levels of risk. Part of the overall financing package includes governmental, where did we go? There we go. Here you go, Lisa. An integral part of the overall financing package includes governmental and quasi-governmental credits and incentives, particularly where there is some public purpose involved in the project use, operations, and/or other factors. Finally, quick look at generally which phase of the project is generally funded by which capital stack layer. So, towards the beginning, you're going to have equity. That's the common and preferred equity when they're conducting due diligence and doing concept feasibility and the like. When you go to acquire the land and go into pre-development phases, it's a combination of equity and debt, the land loan to acquire for the acquisition. The land loan will convert or add to a construction loan and equity on pre-development and development. And then you go to operating loan and equity on the sale and stabilization. I'm not going to go into any more detail on that because what I think we all want to do now is hear from our speakers. Hopefully that's a little bit helpful, though, to set the stage for those who may have a little less experience in this space. In order to focus on content, is going to be quick. You'll learn more about what these women do through the discussion. Please post any questions for the speaker in chat as they go, and we'll try to address them either during the first portion or the workshop portion. So I am very pleased and excited to introduce our esteemed speakers and Crew New York members. Tricia Connolly, Managing Director of the Ackman-Schiff Real Estate Group, LLC. Lisa Lim, Partner, Ackerman LLP, a sponsor again, by the way. And Nicole Radomski, Vice President and Senior Commercial Loan Officer of Valley National Bank, also a sponsor. To kick off the discussion, I'd like each of you to let us know the following 3 basic things about you and your place in the development finance space, and then we'll go into greater depth on some of the issues that you're facing. So, Tricia, briefly describe your current role. Tell us which development life cycle phase you finance, fund, and/or advise on, or your clients do, and which layers of the capital stack your company or clients are active. And I can.
Hi, Tricia Connolly.
Go ahead.
I work in all life cycles of a development project. And as you saw on the capital stack chart, anything from a senior loan to subordinate financing that can be mezzanine or preferred equity to joint venture equity and to co-GP equity. So we sort of manage it all. So if a client comes to us on any stage of a development, whether they have a permit or they haven't had a permit or the project isn't complete yet, we see all life cycles of the development stage and all access to the capital stack.
Thank you very much, Tricia. What about you, Lisa?
Yes, good afternoon, everybody. Thank you, Barbara. That was a really great presentation to set the stage. I am a real estate partner at Ackerman. We are an Am Law 100 firm, and we are full service for real estate. We're one of the largest real estate groups in the country. And we see all phases of the development life cycle also. We see things from concept to land use through acquisition closing, finance closing, lease up, stabilization. So we sort of see the whole gamut, and every piece of real estate is a unique commodity with certain attributes and extremely interesting to work on. And we basically try to help our clients. We have a lot of developer clients cobble their deals together because it is so challenging to get a project up from beginning to end, from trying to get the land rezoned to, getting all the financing together. So all very challenging, all very interesting. Thank you.
Thank you, Lisa. And Nicole.
Hi, everyone. So I am a commercial loan officer with Valley National Bank, and I've spent my whole career providing senior secured debt to various commercial customers as well as high net worth individuals. The asset I primarily focus on always is real estate, first and foremost. And then in addition to that, from time to time, I handle operating and working capital loans as part of the financing that I do. So my goal every day is to interface with customers who are looking for help customizing their financing solutions with regard to their real estate, depending on the asset class. And outside of myself, my bank offers unsecured or the construction and bridge side of it as well. So I may be coming in at the beginning, the middle, or the end, but in particular, my level of expertise here is regarding the permanent secured financing.
So all 3 of you basically touch most of the development phases, as you mentioned, and may provide or advise on multiple layers in the capital stack. So that's great to know. Tricia, I'm going to go back to you again. So as I think everybody here must have heard once or twice, the Dow dropped about 1,200 points yesterday as a result of the unexpected increase in inflation, driven in part by consumer spending, fears of more aggressive interest rate hikes and the like. I know there's still a lot of volatility and uncertainty, but the day after, in your space, you and your clients must be thinking about, what does this mean? You know, what are we going to do? Are we going to pivot? How long are we going to wait to make some conclusions? So what are your preliminary thoughts on its impact on your clients and development in general?
Yeah, I mean, we've had 2 negative quarters, which is not what we hope to see, but it's the reality.
Mhm.
And I think this all just sort of happened in kind of the last 24 hours. And once
Right.
the Fed meets in September, everybody's speculating that rates are going to go up 75 basis points. We're already seeing it now, regardless of the next interest rate hike, that properties are just seeing a little they're just over levered, right? Properties are over levered, multifamily still really strong. And so based on your graph that you showed everybody on this call, that just means people are going to be looking for places of equity and subordinate financing. They're going to go to people like Nicole and say, Nicole, if you're only able to give me 60% leverage, I need to get to that 75% that I got last year. I'm going to need to put in a subordinate piece. And so that is what this market sort of screams when we approach this recession, that people are going to need access to capital to get these projects done. And we're going to have to get creative and put more creative financing in place.
And so by that subordinate piece, just explain a bit about what you mean by that, Tricia. Meaning
So
it's,
if you-
it's, oh, go ahead.
Yeah, so a mezzanine and preferred equity, when we say subordinate financing, is in the most subordinate position to the senior loan. So Nicole works at Valley Bank. She has to agree to allow someone to come into that position and has to give them what we call a recognition agreement, give them acknowledgement agreement. There's documents in place that the senior lender and that subordinate piece have to negotiate together. So not every senior lender will allow that. They don't want someone in that piece. They want it to be JV capital. So this sort of over levered and recession and higher interest rate world that we're in, we're going to be working with people like Nicole and Lisa on structuring the documents to allow, or to get creative for these clients to allow these more subordinate financings in these deals, because they have to get built somehow and the money's got to come from somewhere.
Right. Thank you, Tricia. And by that also, subordinate means will be, paid after the senior lender, and will have less of an interest, probably no collateral or a lesser interest in the collateral and whatnot. So they tend to therefore take a higher rate. They have higher risks, so they're probably going to charge more money. So Nicole, how are you going to feel about it when Tricia's clients come to you and say, we need you to negotiate with a subordinate lender, or maybe they are the subordinate lender. We need a piece of the deal because you won't fund the whole thing, or you won't fund the 85% or the 75%.
I definitely echo a lot of Tricia's thoughts that she had following yesterday's volatility and activity and what we're seeing. So what I expect is that a lot of my clients that are negotiating right now with me are going to be racing, trying to get to some finish line. And when I can't give them what they may fully need, there is going to need to be a much greater conversation about what can the property handle, where can they source the deficit, the shortfall. And it's going to definitely call for creativity. And I hope to touch upon it later on in our discussion today, but I had one of my most interesting experiences and opportunities over the past 12 months involving a subordinate mezzanine situation, and the deal evolved so much. And I'm expecting a lot more of that to come over the next 12 months.
And, while on the one hand, Nicole wants to be sure that her position is not impaired at all by having subordinate lenders and others come into the picture. On the one hand, on the other hand, she knows that, well, that might mean I get no deal, because if we can't bridge that gap or fill that gap with other financing, then the project isn't going to happen. So that is, the motivation that's going to drive the various lenders and capital providers in the capital stack to work together they will often enter into also what's called an intercreditor agreement, which basically describes the respective rights and obligations and priorities of all of the lenders that are involved in that picture. Lisa, have you been hearing from clients at all about, what went on yesterday and how it might impact, what they're seeing and where they're heading, or, any thoughts that you had preliminary? I get it. The situation hasn't played out yet.
Yeah, I don't know, this is my own personal opinion. I don't know if the Fed always knows what they're doing when they're raising interest rates, because traditionally it's been, sort of the temper for inflation, but I don't think, post-COVID, this is a slightly different economy than what they're used to historically. And we've had, major supply chain issues, which we're just emerging out of. We've had shutdowns, which we're emerging out of. And I just don't, I don't have, my personal opinion that this is the requisite tool to deal with inflation, because this is not a traditional economy. This is not what we've been dealing with, is not what we've seen over various, development cycles. So I think that this actually presents an opportunity for equity, for people to come in with equity and to provide member loans, to basically, be able to position themselves to buy properties that might be facing some distress. So I think there's an opportunity. I actually think the best hedge against inflation are hard assets. So land, real estate, income producing real estate are really the best ways to hedge inflation, because you're always going to have cash flow and the value of your asset is likely to appreciate. So I would encourage my clients, if they don't need to borrow so much and they can get into a deal where they can use some of their family resources or their own capital, buy some assets. It's going to be a good time to buy.
Opportunistic. It's opportunistic if you can do it. Nicole, putting aside yesterday's activity, how have inflation and interest rates been impacting, your company, Valley Bank's development financing decisions, and how have they been impacting the markets generally, and what property classes are you seeing impacted by that?
Yeah, we're definitely seeing the impact of inflation and interest rates. I think we're tending to push the swap interest rate, which I don't want to throw a term out that might be confusing to most, but a swap is just a way a customer today in an uncertain interest rate environment can fix a rate and have that fixed payment, and the bank deals with it on the back end by selling it off to the market. So this becomes so much more attractive to us, and we push it that much more with the clients so that they don't have the sensitivity to the rate. We can lock something in for a lot longer to them. And, typically customers want to lock in for a shorter period of time so that they have options down the road and they don't get locked in too long. Not so much right now. Customers actually are concerned. They don't know where their tenancies and the rent rolls and the cash flow will be going in the next 24 months. So locking it in longer and making sure they can deal with their cash flow is more important to them. So we're working on those types of, which, involves our attorney contacts so much, because it's all the devil in the details of those documents. But we're definitely looking at more pulling back slightly on loan to value when it comes to this this interest rate environment and inflation. We're cutting back a little bit on our loan to cost. We don't want to be as far out as we normally would have been 12 or 18 months ago. And we're also addressing this in covenants. For sure.
And when you say not as far out, what do you mean by that?
So loan to cost and loan to value were something in an environment when we were not in the sensitivity. We might be happy being in the 75 to 85 range, even for a middle market bank like myself, which, we're conservative enough.
And when
But
you say
today we're pulling back.
75 to 85% range, you're talking about making a loan in the amount of between 75 and 80% of the value of the property. Is that what you mean by that?
Yes.
Oh, okay. Okay, good.
So we would be looking to pull those back a little bit, tightening the reins a little bit, depending on the asset class. So that's
So
what
less risk.
Yes.
And Tricia, are you seeing the same approach from your clients, or what are you seeing, in light of the inflationary and interest rate environment, putting yesterday aside?
Yeah, I think the biggest hurdle for us is really getting sellers and buyers, in the acquisition world on the same page. Before it was around Mother's Day and then Father's Day, when we really saw the interest rate spike. So if you were paying 10 million for a property and your interest rate was X and you expected your returns to be Y, and then now your interest rate went up and your cost to buy a cap went up, and there's a lot of things that have increased. So your seller still wants $10 million, but the buyer can only make X amount of money now because he's putting that much more in to spend on all of these costs. So we've seen a lot of pushback on both sides of, who's going to duke it out, who's going to win.
Mm-hmm.
And I think now that kids are back in school and everybody's back from the beach and here we are, people have to agree to a number or it's not going to sell. And you're starting to see people come to a realization of maybe it's not 10 million, maybe it's 9.2 now. And that 9.2 allows your buyer to obtain the same returns that they were getting before. And that's, we're all seeing it in different avenues, but that is, to me, the biggest challenge. And on the construction side, the more costs go up, it all goes into their returns. How does Lisa Klein make the deal pencil now if they still want $10 million, even though it's worth 9.2? We're all trying to make things make sense financially. And that's why it's going to take a lot of us to have patience and creativity in markets like today.
Yeah, it all goes back to the risk reward proposition. How much risk am I willing to take, for a certain reward? And when those rewards go down, the tolerance for the risk goes down. And when things like interest rates go up and inflation impacts cost, that means the reward you're getting is going down. And so whether you're the developer, you're the seller or buyer, or you're an investor or lender, if your rewards are going down, you're going to rethink the whole deal, or at least what you're willing to offer. Lisa, I know you do a whole host of things, in the development life cycle, and particularly in financing. But if you would talk for a couple of moments about governmental and quasi-governmental credits and incentives, because although that's not cash to a deal or a cash infusion or capital, it does play a really important part of a lot of the development projects, certainly that we see in New York City and major urban areas, and even rural areas, industrial bonds and all of that. Maybe you could tell us a little bit about what you've been seeing in the market recently and how it's impacting the development projects you've been working on.
Sure. So I actually just wanted to comment on what
Please
said.
Go right ahead.
So what I'm seeing in the market, because I'm negotiating several deals now where I represent the seller or either the buyer on a piece of property that will be redeveloped into, like probably a mixed use building.
Mm-hmm.
And what I'm seeing is no financing contingencies. Okay, so that's not
really
what the seller wants to take.
Okay.
And what I'm seeing is sometimes an adjustment in the purchase price to deal with really the higher costs of borrowing.
Mm-hmm.
So what I'm seeing is sellers taking a position where we're not going to take the risk of a financing contingency. You worry about your own financing. It's not going to be conditioned to my contract. I will do an adjustment to the purchase price.
Interesting.
So Barbara, with respect to incentives, I think there are a couple of different categories. So there are some that are really kind of almost equity into a deal. And that would be something like new market tax credits,
right.
Historic tax credits, brownfield tax credits. So those are almost like equity or cash into a deal, which are a really important source of really a source of financing. Low income housing tax credits are the same. They get syndicated, they get used, and they come in really as an equity source. So something that is a really valuable tool for developers. You know, they're all situated a little bit differently, and the qualifications and the holding periods are a little bit different. So for low income housing tax credits, it's usually like a 15 to 30-year compliance period. And there's a very large market of syndicators for those credits. Often the big banks have an arm that actually deals with the syndication. And those, again, come in as equity. Historic tax credits are the same. They come in as an equity source. The brownfield tax credits require a cleanup that is undertaken by a developer on a piece of property that may have contamination. And when they apply to a certain cleanup program, and the cash back is related to the level of cleanup that they've undertaken and the cost that they've accrued to do that cleanup. So, so those are all sort of, oh, and then the new market tax credits, usually used for community facility or retail, not for housing, but it can be done in a mixed use building that has housing and let's say a retail or community facility component. And that is really based on census tracts. So you may be in a qualifying census tract and may be able to get an allocation of new market tax credits. So we use all these tools, and the other tool is Opportunity Zone, which has been very helpful in past deals, and is, you know, again, if you're in the zone, it'll give you certain ways to defer capital gains that may be a source of investment. So that's kind of one category. The other category of incentives that we use a lot on our deals are property tax incentives. And those come in very handy for any sort of development with an affordable housing piece to it. So we often use the 420C exemption, which is a very good exemption. It goes out as long as a regulatory agreement, which is usually, you know, from 35 years and up. Then we've got a 421A, which people, you know, again, this program is expired, or it's
Yes.
sort of a holding pattern right now, but that
Right.
has been a very good tool. And you don't have to do a fully affordable project. You can do a portion allocated, let's say at 30%. And under the old program, do 30% of your project, let's say at 130% AMI. So not the whole project is an affordable project, and you can reap the benefit of that type of property exemption. The Article 11 is another one that usually.
Hey, Lisa, I'm sorry, I'm going to stop you now because I just want to cover a couple of other issues and we are running out of time, but correct me if I'm wrong. It sounds like there are an awful lot of credits that are available to enhance and supplement the capital, the equity that you're getting on a deal, as well as other incentives. And you're not seeing any change in the issuance of those or anything like that? Are you seeing that at all?
No, I think it's a fairly stable market, and
Okay.
become more important as the debt is more expensive.
Yeah. Okay. Okay. And by the way, Lisa is probably one of the leading experts in this area if you ever have a need for that or your clients have a need for that. Nicole, we have all heard often of supply chain issues, and although I think they're starting to resolve, they still certainly exist. And between that and inflation, prices are going up. Are you facing yet borrowers who are running late on repayments or unable to make construction milestones or anything like that? And if so, how are you handling it, or how do you plan to handle it?
So this mostly comes into play for me when we might have built in an interest only, or what I refer to commonly as IO, at the beginning of a deal. And that's usually because I'm allowing time for some stabilization or some build out of a property. So when you incur the supply chain issues, that sometimes is delaying their completion of that time frame, and thus the IO time is really that much more important to them. And we're getting requests to extend that further to allow for the stabilization to to take its course naturally. And we then really do a lot more of a deeper dive on the
Mhm.
property, on the location. And we build in what we hope are fair enough contingencies within that budget and that time frame to make sure it makes sense for them and for us. So I think for the most part, that's when I'm dealing with it. Not so much when I do my permanent or take out financing, but it's when we're working with a property that's not yet fully stabilized, but is near it.
Okay, and Tricia, what are the other project risk factors that you're seeing now, or is it mainly supply? What are the risk factors other than inflation and interest? Any other big risk factors that you guys, your clients are dealing with?
I think we've sort of seen the cost of construction, whether it's labor and prices of wood, lumber, just in general, I wouldn't say sort of bottom out, but we've sort of seen things just sort of stable. So we're not seeing the big fluctuations that we saw before.
Okay,
I think now we've adjusted to Nicole requiring the higher contingency. And so
Okay.
we've all sort of adjusted our budgets. So from that standpoint, I don't think those are really risks anymore. I think we've
Okay.
all gotten used to those. I would say the biggest risks are people just being comfortable doing business in this environment. Am I comfortable putting money in this asset? Am I finding the lender and finding the equity partner to do the transaction is the greater risk. There's a lot of the big banks that are on the sidelines. There's a lot of people not taking on new clients, or liquidity is tight in a lot of the banks. So I think if your lender was normally giving you 65% and now is at 57.5%, finding your equity partner that's going to come into the deal. Those to me are the greatest challenges and risks outside of interest rate, outside of everything else,
right.
is finding the players that can do the deal and finding the money to be able to transact.
And when you say finding these players who are comfortable enough to invest or lend in this environment or transact, do you view that as a short-term challenge or a long-term challenge at this point?
I think people are just trying to see what's going on. We've had insurmountable amount of world-changing events
Right.
in the last kind of 28 months, 30 months. And I think people are just trying to see how things unfold. When you hear, the large banks have liquidity issues, that causes concern. So that cause for concern trickles down to all of us on this call. Whether that's a direct impact of anything that we've said, that just directly impacts our business.
Right.
But one of the principals at my firm said it today best. There's no bad deal. It's just how expensive the deal is.
Well, that's good. Go ahead, Nicole.
Add on that, what I'm facing too is with each of these global external factors that play into decisions, there's also the sticker shock. There's a lot of people that I come into play with that maybe their heads are in a 4% interest rate and they can't imagine going to the 5. And then you have those that are worried that it might end up going to 6. So they're rushing and racing to lock something in right now because they don't know what's going to happen in the next 6 to 9 months. So I have those that are calling me each day saying, can we do the deal? Can we do it right now when I don't have all of my information? But then I also have the others that can't possibly see a way to accepting a rate that's in the 5% range because they were enjoying that 4% time frame on shorter term money during the pandemic and just before. So I'm dealing with emotions as well as like the external global impact that's playing into it.
Lisa, what about you?
I think
Any
people-
thoughts?
Yeah, I think people just have to get creative to cobble these deals together because, with higher cost of debt, you just have to kind of find some gap sources. So I think it's hard to put these deals together. Sometimes it's a small gap and it's still a gap and it doesn't pencil in. So I think be creative, be flexible. Hope that, there's governmental policy that makes doing business easier. I think I just tell my clients, stay flexible. It's hard to figure out how things are going to evolve in this market. So if you stay flexible and alert and, somewhat to the extent you can decrease your leverage, that's always a good thing.
Lisa, just to pivot a little bit quickly, are you finding some or none or all of your clients are concerned about the sustainability of the projects that they're thinking about developing or funding?
Well, I think, my projects are in various stages of pre-development and construction. So it kind of depends. If you're in pre-development and you're really just in the concepts phases, or you're acquiring the land now, and there's going to be a lot of land use work before your project is ready, I think that category is going to try to move things forward of developer if they're in that category of just trying to get their deal off the ground, because they know that the market can change markedly in the next few years. It's very hard to predict how, whether interest rates will go up or down or stabilize. But then there are some developers where they're in the middle of construction, and their goal is, if there's cost overruns or something that they're responsible for, they're just trying to kind of deal with those realities and just try to, put up a letter of credit or do something, with maybe raise more investment on their side just to get the project up and up and done and set up and income producing and leased up. So that's their goal. So depending on where you are in the development cycle, you're going to have some, I guess, shorter term goals and then some longer term goals. But it's very challenging overall.
Okay, I think, we got started a minute too late because of our audio issues. I do want to move to the workshop portion of the program, but this is still involving your input and thoughts, speakers. So to present or to lead the workshop portion of today's program is Maria Elefante. She is the Managing Director, Treasury of Arbor Realty Trust, and she's also the Legacy Leaders Committee Chair, our co-host today, and an integral part of the team. So Maria is going to basically try to bring you, the audience, into the discussion, asking your questions directly of our speakers or and each other. And Maria is going to facilitate that, and we're all here to back her up. So go for it, Maria.
Yeah, so thank you, Barbara. Good afternoon, everyone. Maria Elefante, I'm just going to do a quick introduction, just letting you know I'm with Arbor Realty Trust, and we're a mortgage REIT. So we are lending predominantly in the multifamily space, which includes the single family rental space also. And we lend across all aspects of the of development, from construction all the way through to permanent loans, 10-year, loans. But we're not a bank like Valley National. We're, a REIT. And so we source our equity, and our liquidity is sourced from borrowing from banks such as Valley and or from the capital markets. And we issue securitizations, predominantly collateralized loan obligations. We've done I think we're up to 19 since the recession. So that's where we get our liquidity from, that we could turn around and lend. And as lenders, we interface quite a bit, with a lot of you in the audience, appraisers, engineers, architects, lawyers, all of the above. So I think we'd like to open up the workshop at this point to see, what your roles and how, have you talked to us about your roles and how they interface with the financial aspects of the industry. We can open it up to questions. We can, if you have some comments, just to talk about how your job and your role, what aspects of it have interfaced with lenders, investors, maybe some of the asset managers in the group here can talk about that, because of course, as asset managers, I would think that you're reporting to your lenders and to the financial resources of the project on the, as construction projects move through the process. Another aspect is, I know from here at Arbor, we're tremendously affected by, green initiatives and ESG, right? Today is a big topic in the industry and has an effect on how lenders are looking and investors are looking at projects. Are there things that you're seeing in that world, maybe the environmental experts in the crowd, are being affected, their roles are being affected by these demands by lenders and investors. So we'd like to open it up to the audience and see if there's any questions and comments that anyone wants to share with us. Make it an interactive discussion, hopefully.
And if there are not, I'd be happy to ask some of you for your thoughts, if you don't want to volunteer for that. Why don't we kick this off with Deborah Farallon. Deborah, are you able to speak? I see that you're on. No, she can't speak. That's too bad. She was speaking.
Barbara, I have a question.
Please go.
Yeah, I really was interested in Lisa's remark about this not being a traditional economy right now. And I think we all recognize that with COVID, the pandemic, the shutdown, the war in the Ukraine, climate change, everything is disrupting. And I share a doubt about whether or not the Fed raising the interest rates right now is the best way to deal with inflation, because there's so many reasons for inflation. It's not one single cause. I'm just wondering what the panel thinks in terms of other ways to deal with the inflation, to bring inflation down, if there are other tools than what the Fed is using.
Oh, go ahead.
Oh, no, I would just direct the question first to Lisa and then to any of the other panelists who may have a.
Also driving inflation, Kenny, in my opinion, is labor shortage, that we actually don't have enough, labor in certain skills. I mean, try to find a plumber, try to find an electrician these days. It's actually very difficult. I think again, my personal opinion is if we had immigration policy that was more elastic toward skilled labor, and we could not have sort of this very messy immigration policy, which is kind of all over the place, and we actually, permitted people to immigrate and to work under green cards or visas that were skilled and could actually help the economy, deal with some of these voids, these gaps that we're currently facing. I actually think that would go a long way to easing some of the, kind of all the pressure points that developers have right now.
Thank you, Lisa. Kenny, does that answer your question?
It's a very good response. I'm just wondering if Nicole or Tricia have other insights they'd like to contribute, or.
I very much love Lisa's thoughts on that. And as the lender trying to close the deal, if I could come up with any alternatives potentially right now than raising rates by 50 or 75 basis points to offset the inflation, I would probably change my career right now and go towards that, because it is affecting every single day what I do or what I don't do. I'm not sure what the answer is. I definitely know this is for my time doing what I'm doing, this is unprecedented. And I don't love that word, but in terms of the cost of living and the trickle down effect this has on us all, it's beyond just me making the loan, but it's the impact that the world is having on each of us living our lives and functioning properly. So I see it.
Somebody, if everybody would mute except when they're talking, I'd appreciate it. Okay, Maria, was there anyone you needed to? Okay, hold on 1 second. Deborah, are you able to unmute now? Deborah's got a long question in the chat, but I thought it would be more helpful for her to say it herself. Are you there? Well, her question is this, if you don't mind. So whether any of you panelists are seeing as many workout supplemental loans and refis, I was wondering about this myself, as originations and loans. So basically, you know, is the mode going now towards refinancings and restructurings, workouts, or is it still a lot of loan origination flow? And then the second question is whether your companies or clients who are in more than one level of the capital stack are selling off any of the pieces.
So I would want to answer this question by saying we are not finding ourselves facing a tremendous amount of workouts, but we are facing a tremendous amount of refinancing customers that are heading into a rate reset, but want to do something early and take advantage of this market before the unknown, which they expect to be worse. And I definitely think the workout issue is probably because we were proactive in tightening those credit criteria earlier on and maintaining that, because if we hadn't and we'd been extremely liberal, I think we would be inundated with the workouts right now already. So that's probably just a cause and effect for that.
Lisa, what about you? You've got clients that are in multiple layers of the capital stack. Are they thinking of pulling back on any one of them?
Barbara, I tend to represent more on the developer borrower side, but I
Got it.
do have clients that tend to be investors in a project, more as sort of almost like a not as a managing member, but more as a, you know, sort of more passive member. I'm involved with several workouts where some loans are made and that we're figuring out a way that a member that made a loan can get some repayment. How does that come out of a deal? Like at what milestones? So I'm involved with several of those type of scenarios right now where I'm going to be doing a massive workout on some of the, you know, some of the underlying debt that and some of the structuring that needs to happen in order for my clients to really get paid off.
And what about you, Tricia? Again, your clients also are in various parts of the capital stack. Are they holding for now, or and are you starting to work out anything yet?
So I think we're starting to see what everybody thought was going to happen in COVID. You know, now it's 2 years later, and you're starting to see a small sign of some people not really willing or wanting to finish paying out their notes and restructuring and recapping, and the workout word will probably happen soon. It's happening in the Blackstone and the BlackRock world, but
Right.
to hit all of us, I think it's you know, we're not quite there yet. We're still trying to work it out. We would tell everybody to work everything out with their bank. It's just taking time. So I think people are trying to work things out, and we're earning our fees helping them do so, but also trying to get creative on restructuring. But I think the workout word is it's there. It's just it's not really on our desk yet.
Hovering. It's hovering. Maria, if you don't mind, there's just one more question in the chat. I'll just ask that, and then we'll finish.
Sure.
So thank you, Madeline. Karsh, Madeline wants to know if you're seeing changes in the markets impacting particular asset classes differently. For instance, is commercial more challenging than affordable housing? So how are the changing markets impacting asset classes differently from a finance point of view? Any thoughts on that, Tricia?
There's a lot of thoughts.
How about one? How about one?
I'll pivot because I've talked a lot, so I'll pivot.
Oh, okay.
Well, I can
Please
have
go.
some input on that. I mean, I was going to mention, I mean, in you know, we're agency lenders, so we are a Fannie Mae and a Freddie Mac lender, and there's definitely a mission there that they strive to pursue, which is, affordable housing and really trying to bring liquidity to the market at times like this, particularly when, the other credit sources are tightening up because, and it's tough to go out there and get a loan today at a good rate. And what they do is they actually incentivize, borrowers to bring that green aspect or that affordable housing aspect to their deals, and that makes it more affordable. They'll waive certain levels of they'll adjust their rate accordingly for that and incentivize the projects to move forward with those initiatives in the project. So.
Maria, do you think that's because of a sort of a corporate responsibility approach, or because that they then get tax benefits, other incentives, things like that in order to make those kinds of deals?
Well, from the government sponsored, Freddie and Fannie, I mean, that's just their mission. That's why they were created.
Right.
So it's probably
Right.
corporate responsibility.
Right,
Yeah.
right. So it's already, believe it or not, almost time. So I'd like to hear one last observation or thought or whatnot from our panelists. Let's start with you, Nicole.
One of my observations or my expectations in this market is that as we continue to struggle to get people to come back to work fully, the office class of assets is really going to become that much more difficult for us to be creative on. And I think we're going to get more and more conservative on from the permanent financing perspective. And I think you're just going to keep seeing the retail strengthening as a byproduct of people. They are spending money, and even though the prices are higher. So I'm just going to see, I think, properties coming my way for consideration that are of a slightly different composition, and that we're going to be more open to the ones we might not have been before.
Oh, interesting. Thank you, Nicole. How about you, Lisa? One last thought.
Yeah, so I think overall, I think multifamily is going to stay strong. Affordable as a subset of multifamily is strong. I think the hotel sector is coming back. Retail is coming back. I agree with Nicole. I concur with her that maybe the office sector is going to have remaining struggles because we just all work differently now, and we don't feel the need to be in the office 5 days a week as we did pre-COVID. So I think that market, and I can attest, a lot of my clients have been giving up office space. So if they can surrender it without a penalty, they'll do that. If they can sublease it, they've been doing that. So that's what I've been saying.
Thank you, Lisa. Tricia.
Yeah, I would shift gears and just say, I think for all of us on this call, we've been here before, but we're in some rocky times, and it's going to get rockier, and to have a lot of patience and creativity helps. Being honest with your lenders and your advisors and your investors is really helpful. And I think we're approaching really difficult times, and it's been hard, but the more that we all communicate, I'd say communication right now is more important than ever, and communicating with everybody that's involved on a deal, because we can't help solve anything if we don't know. So That's the hardest part of my personal job is I only know what you tell me. And if I don't know, I can't help you. So I think now leverage your advisors, leverage your lenders and investors, and have conversations now. And we're all going to learn together, right? Everybody's in this. There's not one person who's in it and somebody's not. Everybody's experiencing all the stuff at the same time, which does not typically happen. There's always one on top or the other, but we are all truly in this. And I think that is what's going to help everybody get to the end of the year. And I think January, February, and March are going to be very different than Q4.
And thank you, Tricia. And that's not only to deal with the challenges that we are facing and expect to face, but also to discover the opportunistic situations as well, which, to end this on a positive note. I'd like to then close this by saying thank you so much to our speakers. Tricia Conley, Managing Director of Ackman Ziff, Lisa Lim, partner at Ackerman LLP, Nicole Radomski, partner and senior commercial loan officer, not of Ackerman, but of Valley Bank. Sorry about that, Nicole. Also like to thank our event team. They did work hard on this, and I think they deserve to be recognized. Viviana Otto, Maria Elefante, JJ Falk, Sharu Kagawala, Madeline Kirch, Kenny Shepard. I also like to invite you to join us at our October 6th event, which continues the discussion in a bigger picture way with Anne Marie DeCola, CEO of TREP, Lisa Prendergast, CEO of Commercial Real Estate Finance Council, as they're going to talk a little macro about the capital markets, the economy, and its impact on commercial real estate. Please stay in touch, communicate. We're all here to help each other get through this, as Tricia mentioned. And I hope you have a safe, successful, and happy day and week. Take care, everybody.